Have you ever noticed how the bank is willing to lend you way more money than you actually thought? You walk into the bank hoping they'll lend you, say, $300,000 for a starter home, but they come back and say, congratulations, you're approved up to $500,000. And of course, most people celebrate, but I believe this is one of the most dangerous conversations you can have with the lender, because the bank isn't telling you what you can comfortably afford. They're telling you what they're willing to risk lending to you. And those are two completely different numbers. So today we're going to talk about how much house you can actually afford, not just what the bank is willing to lend you. And why this one decision could be the difference between being stuck for 30 years or becoming financially free. And real quick, if you don't already know me, my name is Ryan, and after working years of shift work, nights, weekends, and holidays, I was finally able to become debt-free and hit that net worth millionaire status. So if you're into anything personal finance and work a blue-collar job, please consider subscribing. So now let's get into it. So the first thing you need to understand is that the bank is not your financial advisor. The bank's business is lending money. Your goal should be building wealth. And those aren't always the same thing. A lender looks at your income, your debts, your credit score, and decides if you're even able to pay back the loan or not. The lender doesn't ask if you want to retire at age 50. They don't ask if you want to be able to save $2,000 per month or not. They don't ask if you want to travel, start a business, or have enough money to even sleep peacefully at night. The lender is simply deciding whether you'll pay them back or not. And of course, that's why qualifying for a certain loan doesn't always mean it's a smart financial decision. So let's look at today's mid-2026 housing market. So as of summer 2026, the average median home price is still sitting around $440,000. So let's think about that for a second. So the median household income in America is nowhere near enough to make that $440,000 mortgage payment feel comfortable for a lot of families. At today's mortgage rates of 6.25%, property taxes, homeowners insurance, and maintenance cost, and that monthly payment gets pretty expensive very quickly. And here's something a lot of people do not realize, and that is just your mortgage payment is not your house note. Your mortgage payment includes principal, interest, property taxes, homeowners insurance, PMI if you don't put enough down, HOA fees if you have them. Then of course you still have maintenance. Roofs wear out, air conditioners go out at the worst possible time. Water heaters leak, appliances break, and a good rule of thumb is to expect to spend around 1% of your home's total value every year on maintenance over the long run. And of course, no one thinks about these expenses when they're standing in that brand new home for the first time. And now let's talk about the debt to income ratio, because lenders just love this number. So debt to income, or more commonly known as DTI, is simply the percentage of your monthly income that goes towards your debt payments. And of course, that includes things like your mortgage, your car payment, student loans, credit cards, personal loans. And many conventional lenders today will approve borrowers with debt to income ratios approaching 50%, and some government-backed loans can even go higher than that. So imagine half of every dollar you earn being committed before you even buy groceries, pay utilities, or invest for retirement. And that's not financial freedom, that is financial pressure. Years ago, financial planners popularized something called the 28-36 rule. And the idea is simple. Basically, just keep your housing costs below 28% of your gross monthly income, and keep all your combined debts below 36% of your gross monthly income. Now, is this a perfect rule? Absolutely not. But I think it's a much healthier target than simply asking, hey, how big of a loan can I afford? So let's look at an example. So let's say your household makes around $120,000 per year. That's $10,000 per month before taxes. So using that 28% guideline, your housing payment would ideally stay somewhere around $2,800 per month. Now, could the bank approve you for a bigger loan? Absolutely. But ask yourself this: if your payment jumps to $3,800 per month or $4,000 a month, then what happens to your investing? What happens if that AC unit goes out in July? What happens if somebody loses their job or your property taxes all of a sudden increase the following year? That extra $1,000 per month disappears faster than most people realize. So here's another way I like to think about it. Let's compare two families. Family number one buys the biggest house the bank approves. Their house note is $4,000 per month. They're constantly waiting for payday, and they put very little money into retirement. Vacations, of course, go on credit cards, and then every repair, whether it be a vehicle or air conditioner unit repair, is basically a crisis. Now, family 2 buys a smaller house. Maybe it's not as impressive. Their payment, family 2's, is only $2,600 per month, but that leaves them enough room to max out their retirement accounts. They can also build an emergency fund and are able to invest every single month. This family is able to take vacations without debt and sleep a lot better at night. And fast forward 20 years, which family do you think has more wealth? Is it the family with the larger house, or is it the family that is constantly investing the difference between the two house notes? And I think we all know the answer to that question. One mistake that I see many people make, whether it be car loans, personal loans, or mortgages like we're talking about, is that people are so focused on how big of a monthly payment that they can afford. Instead, ask yourself these questions. Can I still invest 15 to 25% of my income? Can I build an emergency fund? Can I handle an unexpected $10,000 repair? Can I still make it if all my overtime dries up? Can I survive if one spouse loses a job for several months? And if the answer to those few questions is no, then the house is probably too expensive. So I'll tell you my own personal philosophy about this topic. I would rather own a modest house and have a 7-figure investment portfolio than own a huge house and feel really stressed for the next 30 years about making that large house payment. Nobody gets rich because they have the biggest mortgage. People build wealth because they consistently save, invest, and leave themselves margin after every month. Your home should support your financial goals. It shouldn't become your financial identity. So here's my advice. Before you actually talk to a lender, decide what monthly mortgage payment actually lets you live the life that you want. Then shop for a house that fits that number, not the other way around. Because just because the bank is willing to lend you that large amount of money doesn't mean you should borrow it. And I would love to hear your opinion on this topic. So would you rather own a $600,000 house or a $350,000 house, but retire 10 years earlier? And as always, I really appreciate you watching the video. Please like, subscribe, all that good stuff, and I'll see you again next week.